Fintech's been a buzzword in recent years. Fintech businesses have exploded across the nation in less than a decade, finding creative answers to many of the financial industry's long-standing problems, like limited credit access, poor customer service, and complex electronic payment methods. It's not a new industry, it's just one that's changed a lot recently. The introduction of credit cards and ATMs and high-frequency trading are just a few examples of how technology has, to some extent, always been a part of the financial sector. However, the fintech sector's experienced rapid expansion over the last 10 years, and future advancements are likely to be even more impactful. Let's examine fintech in greater detail and discuss how to benefit from it during this economic downturn. Fintech, or financial technology, is a sector of the economy made up of businesses that use technology to improve the effectiveness of financial services. Any company that modifies, enhances, or automates financial services for people or corporations is referred to as a fintech company. Although it's a general term with a variety of meanings, generally speaking, it refers to a sector where innovative technology use cases are created and implemented to streamline conventional finance activities. Although the general public frequently identifies fintech with extremely innovative new ideas like algorithmic trading and blockchain, the term actually refers to a very wide range of considerably more boring applications. They consist of, but are not limited to, back-office risk management tasks, including regular banking, insurance, and others. Other more complicated examples include peer-to-peer payment systems like Venmo and Cash App, automated portfolio managers like Wealthfront and Betterment, and trading platforms like Robinhood. Fintech can also be used to describe the creation and exchange of cryptocurrency, for example Bitcoin, Dogecoin, and Ether. Although fintech appears to be a recent set of technology innovations, the fundamental idea has been around for a while. Early credit cards from the 1950s were generally the first fintech products made accessible to the general public, because they did away with the necessity for users to carry actual currency in their daily lives. Fintech grew from there to include bank mainframes and online stock trading platforms. PayPal was created in 1998, making it one of the first fintech companies to rely only on the internet, a breakthrough that has since been surpassed by mobile technology, social media, and data encryption. The mobile payment apps, blockchain networks, and social media-based payment choices that we use every day are all products of the rise of fintech. However, knowing that a worldwide recession is probably going to happen in 2023, what's the bigger picture? Since fintech companies have begun providing services that challenge the norms, they will inevitably become a part of the ecosystem. These services will continue to develop in order to be in the best possible form, thanks to the numerous innovators in the sector and technologies like artificial intelligence, analytics, and machine learning. At its core, fintech will assist organizations and business owners in better managing their financial operations and processes by applying specialized software and algorithms that are used on computers and increasingly smartphones. However, fintech can also assist you personally in improving your financial situation. To suggest that our personal finances are not under great strain right now is probably one of the biggest understatements you'll ever hear. Homeowners looking for an affordable mortgage are facing severe difficulties as a result of high interest rates. In fact, due to lenders' concerns over customers' ability to make the rapidly rising payments, many agreements are being pulled off the market, leaving debtors to fight to save their houses. Furthermore, both individuals and companies are facing rising energy costs. Add to that regular price increases across the board, including for basic store goods, and it's easy to see why so many people are worried about their money. Despite this bleak picture, staying in control of your finances is critical for your overall financial well-being. The most recent trend in managing personal finances is fintech. As opposed to using traditional methods, it's becoming increasingly popular as a quicker, safer, and more effective alternative. Managing your funds doesn't have to be such a difficult task if you can make use of this technology. Fintech can make the process more practical, effective, and even gratifying for people who are determined to better their financial situation and committed to working toward their targets. So, how exactly can fintech help you maintain your financial well-being, even in these trying times? To start, fintech can assist you in creating a more transparent budget. The most basic component of financial management is planning. According to experts, a number of fintech businesses have already used technology to provide creative solutions to this, relieving clients' stress. There are many apps available right now that let you effortlessly connect to your financial institution to help you plan and budget your money. Some of them include Pocket Guard, Good Budget, and YNAB, or You Need a Budget. These budgeting tools provide you with a comprehensive picture of your spending patterns using real-time data from your bank. They frequently divide things into categories, such as grocery, bill payments, and eating out. Once that's done, they figure out how much you've saved. You can see where the majority of your money's going from this summary. You can then analyze this data and make more educated decisions about how to allocate resources. For instance, you might not notice when you look at your budget breakdown that your mortgage or auto debts are taking up the majority of your take-home earnings. When that happens, you can refinance one or more of those loans to make money or have a lower monthly payment. Or perhaps you discover that eating out for lunch at work consumes a sizable chunk of your income. After looking at these figures, you might conclude that meal planning would be a more cost-effective choice. Some banks even let customers set a cap for each category, limiting them from spending more than they intend to on specific purchases. Even better, Fintech allows you to automate your savings. When it comes to long-term savings, behavioral economists have long recommended making it as easy as you can for yourself to save more money. Even if you can only put aside a small sum every week or month, automating your savings is one method to get a good start. Those pennies and bucks eventually add up. You can achieve this without installing a new app by transferring a portion of your direct deposit paycheck to your savings account. There are several choices to streamline your savings if you'd want to use something a little more high-tech. Some options include Digit, Capital, Chime, and a ton of others. And instead of sitting on your savings, you can invest it. In recent years, the number of investing and saving apps has exploded due to Fintech. More than ever, businesses like Robinhood, Stash, and Acorns are lowering the barriers in investing. Although the strategies used by these apps vary, they all expose users to the markets by combining savings with automatic small-dollar investing techniques. Additionally, Fintech's improved loan accessibility. Loans are a common product offered by fintech companies, who frequently target customers who wouldn't be able to obtain a reasonable rate from traditional lenders. These new, technologically advanced lenders either make use of their cheaper costs or use extra elements in addition to credit scores when determining creditworthiness. Additionally, a lot of digital lending companies have made it easier to borrow money, making it possible to receive a personal loan in just 10 minutes. You have a lot of options to choose from, including SoFi, Dave, Bridget, and MoneyLion. You would need to understand your credit score in order to apply for a loan, and Fintech can assist with this as well. Your ability to obtain a loan, credit card, or other similar resource is mostly determined by your credit score. Even though these numbers are so important, most individuals don't understand how they work. Not understanding that credit ratings are dependent on 5 essential components, not just 1 or 2, might result in making bad decisions. But Fintech, designed for personal finances, can help put things into perspective. Many Fintech apps offer credit score monitoring and guidance. These make it simple for individuals to observe how lenders view their financial health and make the required adjustments to improve it. The availability of credit score apps has increased people's financial literacy and awareness of their financial situation. Users may examine what influences their ratings and how their behaviors are impacting them. With that knowledge and convenient monitoring, you may decide how to repair your credit in a way that'll help you later on get better loan rates and credit card offers. When faced with a financial emergency, it can be tempting to try to control every aspect of your finances and keep a close check on every penny that's brought in and spent. However, automating your accounts might help you organize your finances and better understand your financial priorities. You might even be able to save a little money as a result. As the market develops, the fintech sector will continue to adapt in order to assist you in managing your money. There will be an increase in the number of solutions available to assist you achieve your particular objectives thanks to new fintech technology and services geared toward personal finance. Making the most of your money will undoubtedly be made easier for you if you're in tune with these improvements.